Welcome to a session on cost of capital, capital structure, and financial leverage. To start with, we need to understand that capital comes in various forms. A firm is financed by the following. Number one, a firm is financed by share capital, which comes in what we call equity or common stock. It is also financed by a special kind of share which is called preferred stock or preference shares, except that this is a peculiar kind of share. It is treated to some extent like debt because the kinds of shareholders that possess such shares do not have the company's very good intent. Theirs is to make a profit, they're speculative investors. A company is also financed by debt or loans. And finally, a company is financed by the retained earnings, the profits that are made and are plowed back into a business. Those are called retained earnings. Now, each of these capital, they carry a cost attached to it, and that is what we call the cost of capital. Now, the cost of capital is one which each of these providers of capital demands as compensation for using their funds. To the provider of these funds, there is a required rate of return. Now, why is cost of capital important? Number one, it is important for value maximization of the firm. It is important also for capital budgeting decisions. It is also important for other decisions that we will talk about. So, the form of capital that a firm uses in financing its business makes what is known as the capital structure. A company may use one type of capital, say common stock, or it may use a combination of all the three or of two. So we're going to discuss each of them individually. There's what we call debt. Debt is simply borrowed capital. The lender, in exchange to this borrowed capital, would require the payment, and this payment comes in form of interest. So the interest paid on debt is given at a rate which is called the cost of debt. And since this expense is deductible under tax rules, it cannot be deducted twice. It creates a saving to the company due to the fact that under the international financial standards, you cannot pay for an item twice. So to protect the company, there's what we call a tax shield. Tax shield has one major role, and this role is to lower the overall cost of debt, which is a benefit to the company. That is the role of the tax shield. Now, how do we calculate the cost of debt? We're given the debt cost as 10% and a tax rate of 40% for a company. We are being asked what the after-tax cost of debt is. The formula is KD times the tax shield, which is 1 minus tax. So 10% minus 1 minus 0.4. So meaning the cost will, instead of 10%, be deducted to 6%. So this is the advantage of using what we call debt for financing, because it lowers the charge of interest to be paid. We also have the cost of preferred stock. Preference shares are a hybrid from equity. They are semi-debt in nature and semi-equity. Semi-debt in the fact that these guys are owed the money. They are given a fixed percentage when they invest in a company. they expect a return. And so if preference shares are at 10%, it means they are entitled to 10% of the price paid per share. Formula is KP is equal to DP over price of share. So unlike in debt dividends, on shares, you're not allowed to do deductions for expenses. An example, a preferred stock which pays $11.70 is selling for $100. We are asked to find the cost of preferred stock. So we simply divide the dividend paid, which is 11.70 divided by the selling price, which is 100. So we're going to get 11.7%. So when you divide that, you're simply getting 11.7 over 100 times 100. So the cost becomes 11.7%. We also have what is called the cost of equity. Equity is the capital supplied by the ordinary shareholders. These are the real owners of the business who have what we call voting rights. They are given the residue after the preference shareholders are paid. These are paid in two ways. We're going to use two valuations of cost of equity. The first one is called the CAPM, capital asset pricing model, the CAPM model. This is given by the cost of equity, is given by the risk-free rate plus expected market return minus the risk-free rate times the beta. Then there's what we call the dividend growth model, which is given by D1 over PO plus growth. So in an instance where we're given a stock whose risk-free rate is 8% and the expected market return is 14% and a beta stock of 0.7. So using the CAPM model, our 8% risk-free rate is here. Our expected market return, the difference between the market return and the risk-free rate is sometimes called premium. So if you're not given expected market return, they just give you a premium of, in this case, 6%. It replaces the difference here. So now that we're given the expected market return of 14%, we subtract the risk-free rate of 8%, multiply by 0.7, which gives you 12.2%. So this is our cost of equity using CAPM model. The other Gordon's model, which we looked at in the previous session on stock valuation, where given dividend paid in year one as 1.43 and the growth rate given as 6.6% for a stock whose selling price is $25.54. What is the cost of equity using Gordon's model? So D1 is 1.43. Our PO, the price of a share, is 25.54 plus 6.6, which is a growth rate of 0.066. The final answer will be 12.2%. So ensure you multiply your answer sometimes by 100 so that you convert it into percentage. And finally, we have what we call the cost of retained earnings. Now, the retained earnings usually belong to the shareholders and are supposed to be paid out as dividends. So the cost to the shareholders is an opportunity cost forgone. So retained earnings bring in an antagonism between the managers of the business and the shareholders. Much as possible, perfectly, the managers would want to use profits for other um, operational activities, whereas the shareholders would want that to be paid to them because they understand that retained earnings don't have what? An interest attached to it. So usually the retained earnings are contained in what we call equity, treated under equity. So the cost of retained earnings is the same as the cost of equity. Then collectively, we have what we call WACC, which is a weighted average cost of capital. So when a company with a given target of capital uses different forms of capital in its capital structure, an average cost of the capitals will be computed, and this is called the weighted average cost of capital, or WACC in short. It is issue. This is based on the weights themselves. So the weight of equity times the cost of equity plus the weight of preferred stock times the cost of preferred stock times the weight of debt, cost of debt, then you multiply the tax shield. So W stands for the weight, KE stands for the cost. So we're given a capital structure for a firm where we have cost of debt, which is 3,000, preferred stock 1,000, common stock 3,000. So when you total these up, we get 10,000. So this 10,000 is our total for the capitals that we have. So the weight of debt is 3,000 over 10,000 is 30%. Preferred stock is 1,000 over 10,000 is 10%. And common stock is 6 over 10, which is 60%. So these are the weights. So weight of debt is what? 0.10. So weight of preferred stock, WPS is weight of debt is 0.30. Weight of preferred stock, which is 0.10. So on, it's the same thing. I'm just trying to show you that if you see them converted into percentage, you are talking about the same issue. Common stock is equity, 0.6. So using the WACC, we are given the cost of debt 10%, the cost of preferred stock 12%, the tax is 40, and cost of equity is 12.2. So using the cost weighted average cost of capital, our WACC would be the 60%, which is 0.6 times the cost of equity, which is 12.2. So one is in decimals, the other is in percentage. Okay, if you put everything in percentage, the final answer multiplied times 100. But if you put 1%, one in a decimal, you just get the answer directly. The cost of preferred stock is 0.10, and here the cost, the weight is 0.10 and the cost is 12%. And finally, the weight of debt is 0.3 and the cost is 10%, except that this cost of 10% will be negated by a tax of 40%, whose tax shield will be 1 minus 0.4, which is 6% that we're going to have under the cost of debt. So our overall work will be 10.32. Now, work is computed even using what is called the book value of work. Here, the weights are based on the par values for the capital components of the firm's structure, as we saw in the example above. So another approach in using work is where we're using the market value to determine the weights instead of the book values. The above approach was using book values, now we're using the market values. So the market values of common stock will factor in issues of retained earnings, since the market price of the share will adjust relevant information, which includes profits that were made by the firm when the market values have been given to use work. So determining Using market values, you can look at a question as follows. A company has 1 million shares standing with a par value of $2.0. The market price of debt is $2.5, which is valued at $1.5 million as market value. The preferred stock has a market price of 1.5 and the outstanding shares are 500,000. So we now are going to calculate the capital structure at market value. So let's start with the debt. So we are told that the debt is what? 1.5 million market value. So this is 1.5 million. Then we go to the preferred stock. Preferred stock, we're told that this is $1.5, where the outstanding shares are 500. So these outstanding shares, to calculate the market value of these ones, where each price is 1.5. So we're going to multiply the 500 shares times 1.5 to get 750. Then the equity, we have been given the price, market price is $2.5, and we're told that there are 1 million shares. So calculate the value of these shares, we multiply $2.5 per share times the 1 million shares to get 2.5 million, the market value. So when we find the total capital by summation, making a summation of all these, so we are going to at this point, are we together before I proceed?
Yes, we are.
Okay, so after finding the total capital, after doing the conversions based on the price per share, we're now going to calculate the weight. So the weight of debt will be 1.5 million over 4.75, which will give you a weight of 31.6. Same with preferred stock, 750 over 4750 to get 15.8%. And the weight of equity is 2.5 million over 4.7 million, which will give you 52.6. So now we're using the market values to calculate the weight. So in summary, the cost of capital for any firm is important to know. And that is what we are going to use to calculate the weight. Also, we use other data that may be given to calculate the overall work. So calculate work after calculating the weight of each of these ones, you'd be given to calculate the cost, or you'll be given an associated question with the cost of each of the capital structure. So this will now take us to a question that had already given okay, so for now, for the cost for work, weighted cost of capital, we're going to end here. The next session, we're going to now look at questions that are to do with the market values and the book value calculation of work. We shall end here.